live like this. So in the event that you have questions at the end or whatever, just understand that we're coming to you probably about a 30 or a 40-second delay just because of the way that YouTube works. So let me start by telling you what we're here to do today. I'm really excited about this. I've done this once before. The response was really, really great. It was overwhelming. You know, you guys have been following what I do for a long time, and it's been so great getting to know so many of you at the Traders Expos and at the money shows and at the World Money Show and at the Italian Trading Forum, and you know, all the places that I've got to meet you guys. It's been fantastic, and I still prefer very much to be in those venues, right? I love to speak live. I love to be there and you know, interact with people and you know, sort of get out of this office and spend some time talking to some fellow traders. But a lot of you over the years have said, you know, you wish that, you know, we could do little touch-ups and do some interaction online. Well, now, you know, the magic of media has come to the point that we can actually stream things over the internet, and you know, at least I can connect with you. I can't quite see you yet, which would be great in my book, but it's good to know that at least you know, you can put a face with you know, with what's going on, even if it is my face. So let's get into a discussion about why we're here today. So for the last 22 years, I've been trading the U.S. equities markets very actively, intraday, and as a matter of fact, my trading partner and I have made our living trading the markets intraday every single day of the year. And when I say my trading partner, you know, you should know the person I'm talking about here is my lovely wife, Julie. So you see us there in the picture on your screen. That's down on the floor of the New York Stock Exchange. And, you know, we've built a business that we started when we were back in graduate school. So we were flat broke and living on student loan money. And got this idea in our head that what we were going to do was capitalize on what was going on in the U.S. equities markets. There was this boom. You know, the stock markets were flying, and it looked to us like there were a couple ways that we could use what we were doing in graduate school as sort of a conduit to get us in front of trading opportunities. Now, some of what we did relied on some pretty heavy manipulations of statistics and market data, and other things that we did were just simple, you know, follow the pattern on a chart kind of things. So this entire methodology developed back in the mid-90s when we were doing research and we were trying to find, graduate students are always looking for numbers to crunch, right? A bunch of you guys are engineers, a bunch of you guys are statisticians. You guys know what we mean. You're trying to find the data so that you can go out there and model things and figure out how things work. Well, for us, it was all about the stock market. You know, my MBA and my master's, my MBA, were business and international finance, and my PhD was in organizational psychology. So I was going to go out there and I was going to conquer the merger arbitrage markets, work for some big six consulting firm, you know, go out and really do some heavy duty stuff. And then I met my wife, and I decided, you know what, if I'm going to be traveling all the time, I want to be doing it for fun and recreation. And we were both finishing our PhDs, so we said, you know what, before we do something else, let's dig into this and see if we can make it work, and we did. Now, we've written a lot about the things that we do, and you can find articles about my trading style and my trading strategies in a bunch of different publications. So there's scholarly journals, there's magazines all over the world. You know, I've been published internationally on every single one of the strategies that I'm going to be talking about today and the strategies that we do in our trading plans. And it's really gone and created quite a backstory for our business. Because when we were in school, of course, our dream was we were going to graduate, we were going to go out there, we were going to build a career, and then at some point we were going to be professors. We were going to come back, we were going to teach other people how to do the thing that we did. Getting sidetracked into trading, you know, all of a sudden it became much more of a, you know, we're going to walk down the hall, we're going to do what we do, And something got lost in the translation. So we decided, no, we can take what we're doing here and we can turn it into the same kind of an endeavor that we would have had if we would have just followed the traditional career goals, but with the caveat that we were going to have a lot more fun doing it. So those of you who know us, you know we are globetrotters. We travel all over the world. We are almost constantly on the go with our son Connor. We take our 11-year-old now. It was his birthday the other day. We take him with us everywhere that we go. He's partially homeschooled. We've built a dream life, and it's really all because of this business. So if you go and you dig into my strategies, if you dig into those articles or you take a look at the books that I've written, you'll see that I've got a very clear, concise method that gets you tactically in front of opportunities. So the entire around the horn methodology, which is the core of what I do, is built around this notion that markets are cyclical and that you can follow that cycle around the horn, right? That you can follow and look for opportunities even on days where it seems like there aren't going to be any, right? Market's down 300-400 points in the morning. We don't care because we've got a set of opportunities in front of us and we know exactly how we're going to capitalize on them. So what we're going to do today is we're going to talk about two of those opportunities, and I'm going to show you how, if you follow these things, you can go and on a daily basis get yourself in front of opportunities for profit regardless of what the market's doing. If it's going up, down, or sideways, these particular strategies that I'm going to talk about today are going to put you right in front of an opportunity for profit each and every trading day of the year. So the first one I'm going to talk about is my hands down favorite strategy. It's the cornerstone of everything that I do. It's called fastball. Now, if you remember Around the Horn, most of you have read the book. That book was written around a baseball metaphor, right? And that's because, if you recall, my publisher said a multivariate analysis of covariance in the United States equities markets is not going to sell any books. So we took that original title and we changed it. We made it about a baseball metaphor. So when I use terms like fastball or backdoor slider or infield fly or Baltimore chop, those are just easy ways to remember what these patterns look like. And in a lot of cases, we found we could take the statistics out of them and use simple pattern recognition as a way of getting you in front of the trades. So this first one, fastball, is my favorite. This is an expansion of range and volume setup. I'm going to get into it right now and show you how we trade this every single day. So it's called a fastball expansion of range and volume. And what happens with this one is we're looking for a day where the range is the widest of the past 10 trading days. So the past 2 weeks, we want to see range greater than 10 days worth of trading data. We want to see volume in this case to be heavier than the past 10 sessions as well. And then I want to see, in the case of a short, a move lower with a close in the bottom 25% of the daily bar. In the case of a long, I want to see it open in the bottom and close in the top of the daily bar. And on a short sale, what we're going to do is we get short 10 cents below the low, and on a long, we get long 10 cents above that high. So in either case, what we're going to do is we're going to target underlying support and resistance or overhead support and resistance. Those are always going to be the targets on these trades. That's why this is such a powerful trade. Now, the core variety of this thing has been a staple for us for all 22 years that we've been trading these. And that one really goes and capitalizes on some basic market dynamics in the NYSE. So it trades New York Stock Exchange listed stocks that are making those range moves. There's another version that we came up with last year, and that trade alone, by the way, if you look through the results, now you guys are all going to have access to my trading plans all the way back to 2006 and all the results back to 2006, and you'll see that that fastball setup is the one that has produced the lion's share of the profitability of all the plans that are going out there, of all the patterns that are going out there. So a couple of years ago, Julie said, you know, NASDAQ has quieted down a little bit, right? It's still a different animal. It's very different than the New York Stock Exchange. New York Stock Exchange, as two psychologists, is something that we're very comfortable with, because on the NYSE, what happens is you've got a specialist making a market. He's called a designated market maker now, right? He's not a specialist anymore. Designated market maker is making the market in the particular stock. It used to be the case that then when you tried to transition over to the NASDAQ, what had happened is there's so many players in that game, it was hard to narrow things down. So about 2 years ago, we started looking at, is there any way that we can capitalize on NASDAQ volatility and increase the ability of this strategy to profit, get even more out of it every day? And at that time, I was working with a hedge fund, and we were trying to figure out how we could diversify enough to put a lot of money to work with these strategies. And what we came up with were some enhanced criteria for the fastball, and it's called fastball XRV in this case. And what we're doing with this particular algorithm, so this is a little bit different. So I'm going to show you how you can go and just spot these things by eyeballing them on a chart. And this enhanced criteria, this is actually something that I put out for members of a trading service as well. That's limited to 60 members, so there's just a couple memberships ever that are available there. But the XRV goes through and statistically manipulates market data to further filter what it is that we're looking at. So it's looking at NASDAQ securities as well, and what it does is looks for signs of persistent buying or persistent selling on the part of a particular institution over the course of a day. So now, instead of just saying, well, did the stock open low and close high, what I'm saying is, what happened over the course of the day as the market makers were working an order? So if, let's say the stock opened at $50 and then it started moving higher, now it's at $55. We're looking at things here like, okay, well, does the market maker then continue buying, continue pushing higher, or are they looking for the relationship to the volume weighted average price? Are they pushing price back down again? How many shares are they pushing price back down with? What's the reaction when it gets back to that volume weighted average price? Does it make the move higher again? If it does, these wind up being these enhanced setups that I call XRVs. So if you wind up being part of that XRV program, right, understand that what it's doing is it's looking for market data that's coming from an alternative data feed, and then it's going through and it's looking at typical bid-ask spreads, it's looking at market maker momentum, and in this case, rather than targeting underlying support or resistance or overhead support and resistance, what we're doing instead is we're using either floor trader pivot lines to establish our profit objective, or we're going to go and just target $1 per share. It sounds arbitrary. It is not arbitrary. We did the research, we did the math, and what it came down to was, if it's going to hit a floor trader pivot, it's probably going to wind up reversing, so take the profit. And if it hits $1 per share, that tends to be the statistical sweet spot that says, take your money off the table. So for a long position, in this case, the trigger is just above that prior high. Okay, so a short position is going to be the same thing, just below that prior low. So it's a little bit different than the NYSE version. On the NYSE trades, we're looking for confirmation. On those around the horn plan trades, when you're looking at those, you're always going to see, I'm looking for a confirmation. The confirmation was 1/8 of a point, right? I can date myself, that's how long we've been trading. Today we use 10 cents per share instead of 1/8, which would be 12.5 cents per share. So once we get into these, how are we going to trade them? So this is what we need to look at here. So trading volatility expansions. Now what I'm going to show you is what I call a type 2 setup. The type 1 setup is a pullback in a trend. The type 2 setup is a little bit more robust. This one happens when there's a consolidation. So let's say you have a trending stock. It forms a 5 to 15 day consolidation. Now it's trading in a channel. Then it breaks out of that channel. And that move then has to be the widest of the past 10 days. And of course, as I said, we also want to see volume being higher than the average volume during that consolidation range. We're going to enter just beyond the extreme of the breakout bar in the direction of that XRV momentum. So whether you're trading the XRVs or you're trading the fastball setup, right? These rules are the same with the exception of how many ticks above that prior session's high or below the low of the prior session you're going to be looking to enter. Here's what it looks like. So this is an idealized version. Let's say you've got this trend higher, and then you've got a consolidation range, and then you've got this pop, right? So these are daily bars. This is a daily bar chart you're looking at. That big move up and out is the widest of the past 10 sessions. So the next day, if it was for the traditional fastball setup, we'd be looking for an entry 10 cents above that high. That's on the NYSE stuff. And if it's on the XRV setups, we're going to go just a penny or two above that high, and we're going to look for a move of $1 to the next pivot. So here's another version, right? These can be trend or counter trend. So here's a trending move up into a consolidation range, fastball expansion of range and volume down and out. And from the daily bars, you're looking then for an entry below the low of that bar the following day. Here's an example of a short sale. You would have a trending move lower into a consolidation range. You get a breakdown, expansion range, expansion of volume. Next day you're looking to get short just below there. And here is the counter trend move. You've got to move down into a consolidation range, a pop higher, and then 10 cents above for a NYSE, penny or two above for a NAS. We're looking to get long that stock. So now let's look at an example, and this is going to be from last Friday, I believe, or it's sometime last week. This might be midweek last week. This was in NuSkin. So here you've got a chart, and you can go through and flip and look for these manually. I do this on 1,000 stocks. Every single night I go through and flip the charts, and then I also run that statistical manipulation that I was telling you about, where we're going through, and for the XRV setups, we're looking for a bunch of other hidden data inside the data. But on NuSkin, you can see this one qualified for the XRV service. So what we've got here is we've got this wide range, we've got wide volume, okay? You have a nice intraday build of volume. Those bars out on the right side of your screen there, those are volume by price. The bars on the bottom of the screen, the histogram, is volume by time. So I use volume by price quite a bit in my trading. I find it very useful. I think if there's an indicator that you're ever going to add to a chart, that should probably be it. You're also probably going to notice I don't use anything else. I don't use any oscillators, moving averages, none of that stuff. We key entirely off of price and volume. So the next thing I do is I break it down to the intraday 5-minute chart. So I find my patterns on a daily chart. I trade my patterns from a 5-minute chart. So what I'm interested in looking at next is what happened on the day that this set up. What was it that created that bar? And there's a bunch of stuff that I look at over the course of the session. So here you can see I have a very strong upward move with a lot of pressure, okay? And as I pick these things apart, I'm paying particular attention to opening volume, I'm paying particular attention to closing volume, I'm looking at volume weighted average price, the relationship of what price does to that VWAP as the day goes on. But really, there's a couple things, right, that really key you in to whether or not this institutional trade has legs for the morning. And a big component there is look at those the volume bars, both by price and time, as it's going into the close. That tells me somebody didn't get something done. Okay, because if you're the institution and you started buying early in the session, and then as price is climbing, you're trying to push it back down, you know, so let's say you buy 10,000 shares and then you offload 4,000 shares to try to drive price back a little bit, and you're playing this cat and mouse game all day long. Then it comes into the closing bell. And now you're looking at this and you're trying to figure out, okay, did we get done what we needed to get done for the day? If not, we're going to push it. So that volume on the close there tells you a great deal about what happened. Because if that volume wasn't there, then you would start thinking, well, I think the institution might have done what it needed to do over the course of the session, and maybe there's no trade here for tomorrow. But because of these footprints, right? And the fact, of course, that, you know, my algorithm came up and told me there were some characteristics going on that make this a candidate for XRV. Because of that puzzle fitting together the way that it did, I see the opportunity for the following day, and I go through and I structure an order. So let me show you now how I put together a pre-market bracket order, and let me give you a couple of caveats here in terms of what it is that a bracket order does for me, and then what we're going to want to do once that bracket order is live. So here you see that I have got in my software, Realtick, that I use to trade. You can do this in TradeStation, you can do this in Thinkorswim, you can do this in just about anything. You just have to find where it is, right? I mean, software is pretty robust nowadays. I used to pretty strongly advocate that you had to be using Realtick or TradeStation, or, you know, one of these things with a lot of bells and whistles. But the reality is, over time, most software has become very competent. And if you just take what I'm teaching you here and apply it to whatever you're using, you're going to be able to find how to set these things up in your software. So what we're looking at on screen is a bracket order. And what you can see there is that the bracket order allows me to predetermine all these levels. So I set these up the night before, okay? And what's going to happen here is, if price moves up through that XRV day high, then we're going to buy at 64.56 stop, and 64.66 is going to be the limit. So what that does right there is it tells my software where do I want the order to go live, and then what's the worst slippage that I'm willing to accept. So this is, it's like a market order, but it's not, right? Because it's not just going to put you in wherever the thing wants to go. It's a marketable limit order. It remains marketable through that 10-cent spread. And as you build out this order, then what you're going to do is you're going to say, we're going to have an initial stop loss order at $64.25, right? That's going to be a stop market order, and that's only for the first few minutes that the trade's live. So if you guys have been, you know, following the daily videos that I put out, or following, you know, going to the traders expos and talking to me about these things, those initial stops, those hard stops, are only there until we find out what the market is doing in this particular stock on the day that we're trading it. So if we start seeing support and resistance right after the open, and say it's at $64.30, we're going to move that stop up. And in the case of this software and many pieces of software, you can do that right on the chart, just grabbing the line and moving it. It's a very simple thing to do. So I'm going to hold my exit order for a profit at $66.35, and that's a limit order. And then I'm also telling my software, only get me out of the number of shares that you got me into. So don't reverse my position on me and get me short. Go ahead and get me out for exactly the number of shares that I was filled on. So let's say I wanted 1,000 shares, but I got 657. It's going to close me out of 657 when it closes this order. Now, there are lots of benefits to bracket orders, obviously. You can completely structure your order. That OCO is going to work for you. It's going to kill that other leg, right? So that if one of those orders goes off, the other one is automatically going to cancel. You can walk away from the machine, not have to worry about the order. And you can change your orders then directly on your stock chart. The drawback to an OCO is, if you put a bunch of these out there, the assets in the account are going to get impounded as soon as the order is placed, right? It's going to use your margins. So in some cases, you want to use conditional orders to trigger these things, so that instead of your order just being out at your server, your order stays in-house on your machine until it becomes marketable, until it goes live. So that's just a matter of housekeeping for you. You know, generally speaking, 90% of the trading that we're doing is over and done in the first hour, hour and a half of the trading day. So, you know, that's the time of day you're going to be putting your money to work. Rarely some of these will straggle on for the rest of the session, and in those cases, you know, we just let the automation handle it. But let me show you how this one played out. So here you can see you had to move through that prior high, right? You had your profit objective up above, and it's very often the case that it happens just like this. In the first 10, 15, 20 minutes of trading, it goes and it hits the profit target. A lot of times, if we have a trade that winds up being in the money very quickly, it'll happen within the first 5 minutes. So sometimes, having those orders out there can really be a huge benefit, because especially at 6:30 in the morning California time, I'm not always as nimble as I'd like to be. And this makes it really, really easy then for, for me to use these bracket orders and just have this stuff automated and, not have to hassle with it. So this strategy, generally speaking, has done about $10 per share per month since we have been doing it live with other traders. So it's been out there for about a year. We've slowly been scaling our folks into this, because I really can't take the chance that we diminish anybody's liquidity. So we kind of add people 4 or 5 at a time. 50 was initially the cap. And, at this point in time, it'll be 60. So we have room for 7 people on it. But you can see there what it's done January so far, right? So 2019, $10.50 per share traded. And if you look at the history of it since we started publishing this, you'll see that that number is pretty representative of how it does over the course of a year on a month-by-month basis. So last year, 178 points per share traded on XRV, and I think that this, if you know your way around trading at all, if you know how to put orders together and place orders, then this is something you should consider. This is a volatility-based trade, obviously, and for some of you, it's that volatility can be your enemy based on whatever kind of trading you're doing. And I can tell you that in our framework here in our business, and with the folks who are on the service through Trader Insight, my boot camp guys, a lot of those guys have subscribed to this over the year. Everybody's extremely happy with it. So this one, if you're interested in it, is $299 a month. It's got a 30-day money-back guarantee. If you don't think that it's worth the $299 a month, you just call us and tell us you want to cancel it, and we'll refund that purchase price in its entirety. So it's the first 30 days. I can tell you that over the course of a year now, we have had exactly 2 people who have stopped trading the XRV setups, and that was primarily because they weren't interested in a first-hour trade as much as they were in sort of layering on positions over the course of the day. So this has been a real cornerstone kind of a setup for our boot camp guys. They love it. We love it, obviously. Julie and I have been primarily focused on this thing for the better part of 2 years now, because of the way that we can set it up ahead of time, set it and forget it, and it just takes care of itself. So if that's something that's of interest to you, then you can just go to traderinsight.com/seminar. It's going to be the same thing on the next strategy that I'm going to show you if you're interested in doing that. Traderinsight.com/seminar. You can sign up for it. If you don't like it, like I said, just tell us, and no harm, no foul. We will get you a refund, and you just tell us that you didn't like it, and that's good enough for us. So now let's get into our next first-hour strategy. This is the subject of an awful lot of press that we've got over the years, and of this is probably the reason that a lot of you know even who we are, or who I am, right? Is this strategy that I developed for trading opening gaps is different than just about anything that anyone else has ever put out there. It's proprietary, but I tell you how to do it. So I've been very open and very frequent in my publishing about this one. And I think that if you take a look at what we're doing here today, or if we take a look at this this strategy, you probably see how you can roll it into whatever you're doing in your trading pretty quickly. So let me tell you how this gap strategy works. This one, originally, we were looking at the front month implied volatility of the options contract, right? And that's how we were determining, well, if something gaps, what is a statistically significant gap, and how likely is it that that gap's going to fade? that was a lot of work every single day. So you had to go through and import all these front month volatility statistics. And what we found in our own research over the years was you can use true range as a proxy for that volatility and very, very effectively get yourself a volatility model that puts you squarely in front of gap trades that have the highest probability for profit each and every day. So for those of you who are newer to this, this is the only thing that I'm ever going to really sort of push the statistic at somebody, because I think it's important. Excuse me. I think it's important to know how this kind of stuff works. But true range is different than range, right? True range, the range is just the high to the low. True range is the greater value of the high minus the low, or the absolute value of the high minus yesterday's close, or the absolute value of the low minus yesterday's close. So what's that tell you? True range gives you the range including gaps. And since gaps are what we're interested in measuring, true range is the logical thing for us to be using as opposed to just try and range. So here we have a daily bar, right? And the true range is the high price then. And we're going to go take yesterday's closing price. And in this case, if that high price was $50.10 and the close of the previous day was 49 bucks, you got $1.10 true range for the day. So what's this do for us? Well, it allows us to go, since true range is a proxy, right? It allows us to have access to the normal distribution. And the normal distribution starts giving us some tools that we can use in our trading to skew probability in our favor. So assuming that stock market data is normally distributed, which I can tell you it is, and assuming that true range is a proxy for volatility, which I can also tell you it is, then you've got one more assumption, and that's that volatility is mean reverting. And I can tell you I've done a bunch of work on this, and there is a definite preponderance of the evidence that says volatility is mean reverting. That gets us access to this guy right here. This is the standard normal distribution. What's that do for us? See right in the middle there where that U is, that funny looking U? That's called mu. That is the mean, the arithmetic mean of a bunch of data. That's all that represents. So you don't need to be an expert statistician to understand what I'm showing you here. Just understand it's the average. Those two red zones out to the side there, those are one standard deviation from the mean. One standard mean, here comes the magic, 8.2% of the expected excursion from that mean has been accounted for. Now go out in those blue zones. By the time we get out there, over 95% of the travel that we expect to see away from that average has been accounted for. And what that is, we have a very high probability not of a move all the way back to the mean, right? We're not looking to fade the gap completely, close the gap, all that stuff. We've got something here that says mathematically, we've got a 95% probability if a stock gaps out into that second tail of that distribution, we got a 95% probability it's going to move back in. And then all we have to do is take that simple data, right, for true range. We've got 10 days of true range data. Your software will put this together for you. If it doesn't, let me know, and I can send you the calculation for a spreadsheet as well. You have 10 days worth of true range data, and you're going to plug it into this very simple statistical formula for standard deviation. So what this does is it takes the average of those 10 days and it subtracts from each one of the days that average gets taken out, right? So you subtract that from that average. Then you square that to get rid of a negative number. You divide by n, not n minus 1. We've got a very small sample size here. You take the standard deviation of that, and what's going to happen there is that gives you one standard deviation. And in our case, we know we're interested in 2 standard deviations. So here you've got a stock that had a 49-cent move. You'd multiply that by 2, that's 98 cents. You add that, you have your software add that to that average, to that $1.25. That tells you that's how much a stock has to gap in order to have a 2 standard deviation move and give us a high expectancy that we're going to have a reversion. So here's what this pattern looks like. Now these are 5-minute bars, okay? So this strategy we're not looking for on a daily chart. We're always looking for this on the 5-minute chart. And what happens is as soon as the market opens up, we get a list from, we've got a gap scanner put together. So some of you I know are already taking the course. I've got a brand new course that is a full-on award winner. It's 4 hours long, and it gives you every iteration of this, a very rule-based kind of a thing of this is how you trade these things, and this is how you can profit from these things. But you're only looking at the results from that scanner, and then going in and saying, okay, are these news-based trades? Because we want them to be usually earnings-related, right? Earnings-related trades are the best ones. There's an asterisk on our scanner telling us this is an earnings announcement. Here's the gap. It makes the 2SD qualification. And then all that we do after that is, like say in this case, this is a gap down. If that's 2 standard deviations, then we start looking at those highs of the next bar. So we treat this like a pullback. This is the most simple thing. It's like a 1, 2, 3 pullback. And when we get to the deepest bar, you're just following this each bar. Somebody always asks me, well, how'd you know it was going to be the deepest bar? Well, you don't know it's going to be the deepest bar until it forms. Once the bar forms and closes, you now know that the high is less than the bar. As the thing is coming down, each one of those highs is actually your trigger price for the next bar. So in this case, that bar being the deepest part of that pullback, we're going to look to get high just above get long just above the high of that bar. We're not getting high, just above the high of that bar, and then we are going to target the open of that first bar of trading. So that's how this thing fits together, right? Because the open is usually where there's something significant going on. If you take the course, or when you're going through the course, you're going to see there's other criteria that I use: volume by price, how much impact big shares are having on particular levels. All that stuff comes together very easily. It's very easy to visualize all this stuff. But really, the basics of it, the nuts and bolts, you're always looking for where there was a major inflection in the first bar of trading, and that's how you're going then and adjusting where your profit objective is going to be. So here's what our scan looks like every morning. And you can see here it's pretty simple. This resides on its own Apache server, so Trader Insight is serving this up from a dedicated server, so it's fast as lightning. It goes through and does the calculations, makes sure that the stocks that it's presenting are properly categorized for the impact of news. It searches the S&P 500 and the S&P 400 and then compares it to the news feeds that are out there, the corporate actions and things that are going on, to find out whether or not it qualifies for these criteria. So as you're looking, now you can put this same kind of a thing together yourself, right? If you're a mathematician, or if you're an Excel wizard, or you're great with your trading software, then you can go and program up a spreadsheet that does the same kind of scan. Just use that formula that I showed you, and you should be off to the races. But this one gives us lots of time to set up our entries and exits for multiple symbols. So I'm going to show you here. This one was a classic setup as far as I'm concerned. This is another recent trade. So you can see that what we're doing here is we're following those lows as they move higher, right? And we're going to set our entry trigger based on the deepest low. So as this thing moves up, we get to the point where we finally violate that highest low, and that's our short sale threshold. Now take a look over on the right side of the chart as well. You can see that volume by price data there, right? And you sort of see what's going on. This starts putting a picture together for us of where we can expect price to move. So I'm going to set my profit objective right there at the close of that first bar of trading. Why am I setting it there? Because I see that volume by price data. I see that the stock bounced from there, and when it did bounce, it traveled significantly higher pretty quickly. So the travel range down to that point was easy to accomplish, and then once it came back up into there, we can expect to see the distribution start to skew, and we're going to start seeing a move higher. But that gives us a nice place to put a target. And once the target's in place, we're going to have to find a stop loss. And you can see here again, right, very easy to go through and find a level just above our entry price that gives us a very high reward to risk ratio and also is very logical, right? Because a lot of you guys, man, you know, I talk to you and you know, you're telling me you're not comfortable with a stop that's more than 40 cents or 50 cents, so that's where you put the stop. And I've never really understood it because, you know, the market doesn't care how much you're willing to lose. The market just cares about where there's order flow. Right? We're order flow traders. That's our whole business, is anticipating the anticipators, right? Anticipating where price activity happened before and where it's going to happen again. Because once it hits a level, it's very likely that when it goes back and retests that level, you're going to get a rebound. And right, we're playing for small gains here. We're playing for, you know, 60, 70, 80 cents a share usually. And you have to have a solid target and a solid uncle point if you're going to stay in that business and stay alive. So we've got this area right here where a bunch of stuff clustered and volume by price made sense. And then we've got our profit move. So take a look at what happened here. We've had lots and lots of these trigger. If you want to see some that triggered today, you can even, you know, you can pull up NVDA, NVIDIA, CAT, Caterpillar. We had CHFC, and you know, those ran for us in the first hour trading pit. So you guys are going to have access to that first hour trading pit for a couple weeks as well. You'll be able to see how this stuff plays out live. But look where our profit objective was and what happened when the stock got there. Now, somebody always says, well, you know, you could have had a wider target. You could have shot for, you know, a level down a little bit further and got more of the gain. I want to get taken out on the way to that level, right? I want my order to get filled in its entirety. Really, the only way you're going to accomplish that is if you go and put that that target right at something significant. So closing price of that first bar was, you know, where we wanted to get out. And that represented 95 cents per share traded on that trade. So, you know, these come up every day. They've been really solid earners over the years. And if you join us in the first hour trading pit, you will see that there are guys in there who have been trading this and nothing else in their trading account for years and are earning a nice living. So this is a real bread and butter kind of a strategy. And how do you set this up, right? Does it seem like there's a lot of thinking to do on the fly or something? There's really not. You've got your short position, you've got your stop loss, you've got your target, and you know, if you're on the ball, you can set all these things up ahead of time, and you know, you've got your stop, and you've got your limit price, right? So you know where you're going to activate, you know what the worst price is that you're going to accept, and over the course of the, you know, 15-20 minutes at the beginning of the day, what you wind up with is you've got your stop pre-programmed, you've got your target pre-programmed, you know exactly what it's going to do, and you can ratchet that stop in behind, make this an even better reward to risk ratio. And you know, the only management that you have to do really takes place in the first, I'm going to say, half hour of the day, because half hour is where we stop even looking for these trades to happen. So take a look at this distribution. So this is the profitability of that 2 standard deviation opening trade. I call it Baltimore Chop. That was my proprietary name for this thing. I've showed you the calculations. You know what I'm doing there. It's not a black box. These are some amazing numbers. This is just for January. So this puts you in front of a ton of opportunity over the course of the month. So, you know, you can sort of pick and choose which ones you're going to take, but the best practice is, right, if you go through, like I said, a lot of you are already doing the course, you're taking the course, you've already taken the course, whatever. Don't try to monkey with those rules. There's 4 reasons to get in, and there's 3 ways to set targets. So as long as you're following you know, what those rules are, it becomes very easy, even on a busy day. Like say the scanner has 10 setups, 15 setups that it throws in front of us, you'll see that it's very easy for us to go and start parsing those, and we get it down to a list of 1 or 2, and we do it in the room live with you. So if you do join us, and I encourage everybody to join us, so if you're on either XRV or the 2SD course, that room is included, and it makes for a very good place to sharpen your skills. And I know rooms aren't for everybody. Ours is a semi-quiet room, right? Because we just go through and we talk about what we're doing, and all the trades are pre-planned, so there's no calling things on the fly. But I think if you're in there, what you're going to see is there's a bunch of people who are able to put this stuff to work, and have been for many years. A lot of the guys in there have been to our Income Traders Boot Camp. We do that down in Miami twice a year. We like to get down to Miami Beach and do a boot camp. Like I said, we do lots of traveling. But some of the guys in there are just people who took this course and are just focusing on just this trade, right? So this is a real bread and butter strategy, and you can see it put up about 30 points or 38 points just in the month of January. So it's got lots and lots of potential. So if you are interested in that gap course, you can take that again just by going to traderinsight.com/seminar. You can go to that page and sign up for it. If you do, we're going to include Stock Trading 101 and 201 with the purchase. Those are courses that I put together some time ago just to get everybody on the same page in terms of what the markets are all about, and how different brokerage accounts handle trading, right? So that you can get more efficient with the way that you're doing your trades. Because I think in this business, I can tell you, after 22 years of doing this, I feel like I still learn something every day. I feel like I learn something every time I do a boot camp, right? I love doing the boot camps because I feel like I'm that much sharper when I come back from it. And I think that a run through of 101 and 201 is a good exercise for anybody. That's just a couple. And then the mastery course, that's really going to put your feet to the fire. So far, the feedback on that's been out for about 3 or 4 months now. Feedback has been 100% positive. People love that course, and when you get done with it, you're really going to know how to trade these things. And we also include a month of that scanner, so that you can either choose to use that scanner as your method of finding the gaps, or you can then use that scanner to compare, with your own scans, whether or not you programmed that stuff up right. And then we also include historical data so that you can go through and practice. There's a simulator called Trading Sim that all of our students have been using with this. We don't have any relationship with them. It's just a great simulator. And you can go through and just go back through these gaps over time, and without spending any money on your trades, right? You can go through and simulate them and see that you're picking the ones that make sense. And before you know it, you're going to be real good at trading these 2SD opening gaps. And the other thing that I wanted to point out here in the name of the shameless travel promotion is that we are doing a cruise this year. So you guys know we do a lot of trips with our traders. So we have one coming up this week. If anybody's interested, you can still go. There's a few of us going up to Mammoth Mountain to go skiing. It's about 20 feet of fresh snow up there that we want to go take advantage of. It makes for a great trip. It's going to be a bunch of traders talking trading and skiing and having a bunch of fun together. And then the biggie is our Bordeaux River Cruise coming up this summer. So we are going to have a blast. It's 8 days sailing through Bordeaux and going to some of the greatest wineries in the world. Californians, we love our wine. And this seemed like a really good fit. It's going to be me and Dan Gramza is going to be there. So if you're an options trader or a futures trader, he's going to have some strategy ideas for you. I'm going to share some strategy ideas with you. This is going to be a great trip. If you're at all interested, you can at the bottom of the screen there, it gives you the URL for the cruise at the Money Show. So that's an aside. It should be a lot of fun. If you're into that kind of a thing, if you're into big destination kind of vacations, including a seminar that makes it kind of a tax-friendly thing to do, then let us know, and hopefully we'll see you there. We'll all have a bunch of fun. So I'm going to wrap up here, and just say if anyone has any questions for me, go ahead and type them into the dialogue there. And if not, then we're going to go ahead and call it a day. I see here we've got one from Brent. What happens if the first bar is the trigger? What is the price target? So that's a good question. I cover that extensively in that course, but I'm going to give you the $2 explanation right now and say, when you get the first bar formed on your chart, what you're going to do is automatically you're going to draw a Fibonacci expansion on it, or you're going to look for a pivot line, a floor trader pivot. So with the Fib expansions, you don't want to get too a lot of guys use a bunch of Fibonacci numbers. I use 382, 0.5, and 0.618, and then I do 1.382, 1.5, 1.618, and minus 0.382, minus 0.5, minus 0.618. And what that does for me is it gives me a logical place to put my profit objectives. So we will use the 1.5 as sort of the absolute target, and then once it hits that 1.5 level, we'll either scale out of a portion of it and then use the 382 as the retracement exit, or more frequently we'll just take it off at that at the 150% expansion. If there's a pivot, okay, if there's a pivot and it's in the way of you reaching that expansion target, then the best practice is really to take it off at that pivot. Our experience has been that the first bar entry, actually the second bar, right, because the first bar is the bar that's giving you the threshold. The second bar entry is going to be a lower probability trade than the 1, 2, 3 pullback kind of a setup, but they tend to work out anyway, because what happens is you get to the money management threshold, right? So usually when these things hit, let's say 50% of the distance to the target, we're ratcheting up to just about where we got in. So there's a lot more break-evens on that first bar entry. Depends in part. So if you're taking the course, then you're going to see, we want to gauge the morning volatility. We want to see, what's the relationship between the futures market and fair value. Is the broader market going to be pulling the trade for us? If it is, we keep an eye on that as well and look at that as the potential then to get out into that Fib expansion. But for the most part, second or third bar or fourth bar entries are going to be sort of the sweet spot. That's going to be the easiest place to learn this strategy. If you're going to use a first bar criteria to get you in, then I would say, just be very careful. Make sure that you're basing your entry on a violation that has a clear volume level for support, support and resistance volume, volume by price or volume profile that tells you where a stop should be, and make sure that that stop is the reward to the risk is a proper ratio, at least, I must say at least 1.5 to 1, if not 2 to 1. A lot of these things wind up being 4 to 1, 5 to 1. Because what you don't want to have happen is that opening bar volatility, winds up whipsawing you back out of the trade. The first 5 minutes, definitely on these gaps, that's going to be the most volatile time of the day. By the time the second and third 5-minute bars form, those are going to be the ones where, price is really settling in. My favorite version of this trade is when you start seeing that, those bars start shrinking in size, and, that the bar that triggers you in has a really, tight range compared to the first 2-3 bars, and gives you a good place then to put a stop that's really tight. But that's just a risk management kind of a consideration. Okay, let's see if there's anybody else that has a question. And If you do, pop it up there. I don't see anything right this moment. But let me just tell you that just for your future reference here, you're going to get a manual that talks about everything that I talked about today. You're going to get, it's about 50 pages, I think, 45 or 50 pages of descriptions of these strategies so that you can go back over them. You can watch the video again. You know, we'll post the link with a recording of today's seminar. And then you'll get that download. I think it's tomorrow. You should receive it via email. Just download that PDF. You know, if you print that thing out and read it, you're going to get a really much better understanding again of what this stuff is all about. And then, you know, if you really want to dig in, like I said, XRV, you know, pretty much try that for free and see if it works for you. I think, you know, if you're at all competent and capable as a trader, this is something you ought to consider. Right? If you know how to place orders and you know how to get things done in the morning, I can pretty much tell you you're going to like XRV. And then, you know, if you want to do sort of a deeper dive into this 2SD, this Baltimore chop opening gap trade, then, you know, take the course, and there's a ton of resources that come with the course as well. And, you know, and then join us. Make sure that you come and, you know, take us up on the free time in the room, because the room is a really good place to see how you can put all the stuff that you've learned in the course to work every day. And, you know, most of these guys have found that by doing the homework, by doing the studying with the course, and then turning around and coming into the first hour trading pit with us, that it really takes a lot of the mystery out of the whole thing, and it becomes a very logical, sort of sequential series of actions that you're going to be doing to take these trades. Whereas, you know, I know, believe me, I know what all is out there with regard to gap trading, and a lot of it is, quite frankly, I feel designed to throw so much stuff at you every morning that you can never really figure out whether a strategy works or it doesn't. My strategy works, and the proof is in the pudding. And, you know, I tell people all the time, don't just talk to one of my clients, talk to all my clients, because they'll all talk to you about what it is that they're doing, and they'll all tell you what the experience has been like. So we've got a really good group of people. I think you're going to enjoy their company. I think you're going to enjoy meeting them. If you could join us on the cruises or the ski trips or whatever, you know, by all means, you know, if you want to wind up at Mammoth this weekend and do some great skiing, we're going to be there Sunday through Thursday of next week. Get up there. There's nowhere to register with us or anything. You just come up and join us, and we're going to have a ball. So I see there's there's a couple other questions here. Let me just take a look at what these are. And there's a 2-week free trial to, it's not to the XRV strategy. That is a first come, first serve. You have to come in and actually, you know, buy it to try it and then get your money back. We need to know exactly who's on that. So I can't just send out a big wave of subscriptions to that one. But you do get a 2-week trial to our trading room, to the Around the Horn trading plan. You can see every single trade that I've published since 2006, every single trade we took. The results are on a spreadsheet there. You can see every single thing that has been going on behind the curtain here forever. We're very, very open about what it is that we do. Let me see. Question related to light volume stocks. Say more challenging. Why are the XRV stocks lighter volume with larger spreads? Well, you know, XRV capitalizes on finding liquidity pools and finding liquidity, how should I put this, right? You're looking for where the bodies are buried. I mean, you're looking for what's going on in the market that is driving the stock, and who are the players that are making this happen. That data is much easier to pick apart when you're scanning down into some lower liquidity instruments. So, I mean, when you say low liquidity, you know, it's I mean, most of the XRV stuff does 300,000 to 500,000 shares within the first 45 minutes of trading. So we're never really low liquidity, right? So it's you know, I know some of you guys are into penny stocks and all that stuff, and I just have yet to meet anybody who can successfully navigate that stuff unless you're a penny stock promoter. I'm very focused on, it's got to be trading on the big board, or it's got to be trading on NAS, and it's got to be a big major stock in order for it to wind up as part of my plan. So that being said, yeah, you know, they're not the super caps. I mean, the XRV stuff, you know, if Apple, let's say, you know, makes one of these giant moves, you know, good luck even with the algorithm. And the algorithm takes 4 hours after the close of trading every day just to find stocks that are trading from, you know, the typical volume is from 400,000 shares up to about 5 million shares a day. That's sort of the sweet spot for the XRV algorithm. You go and throw an Apple at it, right? And now you're talking 30, 40 million shares transacted, or you know, Caterpillar, or, you know, anything that does a lot of shares. Then the challenge that you run into is it becomes a lot easier for those shares to be sort of semi-invisible, right? If you go through and you look at a big stock, you know, that's trading 20 million shares or even 15 million shares a day, and when you go through and you look at the way that the trades are reported, you've got all this stuff coming in from alternative display facilities, you've got things coming from, you know, routing off of all sorts of exchange. It becomes very difficult to go through and gauge who the source of the pressure is. So, you know, once you're in doing the XRV trades, what you're going to find out is that it's the way that you structure the orders, right? So a lot of boot camp, even, you know, a lot of these very experienced traders will come down and they work with us, and a lot of that experience is about, okay, well, how do you navigate through uncertain waters sometimes, right? When you got big spreads, and I'll tell people, well, you know what, when Julie and I started trading, the spread was 1/8 of a point. We expected 1/4 of a point on our entry, right? So you were 1/4 point underwater if you didn't structure that order right. So back then already, we got very much into the habit of, you know, if we were buying, we're going to work the bid. If we're selling short, we're going to work the ask. Furthermore, when we started trading, you couldn't even sell short at the bid. You know, you couldn't hit bids. You had to satisfy the uptick rule. So we were always working the side of the book that was most favorable to us in terms of how we get filled. And we still teach people to do this. It's still very important to have skills as a trader, to be a good trader, right? I mean, this is really what we try to get people in front of when we work with them is, look, you know, it's anybody can sit there and pre-program a bunch of stuff and just let it fly. But the skill comes into play when you're saying, all right, you know what? This thing's got a 40-cent spread. And if that spread starts moving in my favor, it's going to be at my profit objective instantly. But if it starts tracking against me, right, it's gonna wind up taking me down 40 cents. So if that's Julie, by the way, if you're working the book, if you're working the bid or you're working the ask, then you know what you want to do is make sure that you're on the side of the spread that's favorable to you. So if I'm going to get long, I'm going to come in on the bid. If I'm going to get short, I'm going to get short on the ask. If the spread is 30, 40, 50 cents. If the spread's 6 cents, 7 cents, right, 10 cents, then I might just take the easy way into the position. But for the most part, if you have a big spread, that's a very good question. You need to work that trade. All right, now let's see what else we have in terms of questions here. And see, there's a couple more. Sri, how to get in touch with a couple of your longtime clients to talk to them, ask questions, get a better understanding about what's offered. That is that's a no-brainer. So you can send us you can send an email. I would send it to julie@traderinsight.com, and she'll send you a link or an email with the names of, you know, let's say 5 or 10 people to call. There's people who are very, let's say, evangelical about what we've done over the years, and they're always happy to talk to people. And you can also, in that first hour trading pit, when you take your, you can have 2 free weeks in there, a couple weeks of interacting with those guys. I guarantee you, if you just pop a note in there and say, hey, you know, I'm interested in talking to somebody about, you know, what it is that you learned with Julie and Adrian, what it is that you've learned over the years, right? You retired, you're a full-time trader now, you know, how did they help you transition from being an engineer, being an architect, you know, being a dentist, being a doctor, lawyer. We've had people from all walks of life. They've all been professionals, but you know, they've all decided that they want to move on and do this, and they'll tell you through a different set of lenses, right, than what I'm gonna, you know, I can tell you what it is that I'm doing for people or that I'm teaching people. They can tell you how it's worked for them or why it's worked for them. And that helps you then to put together a good narrative for yourself of whether or not this is a good fit for you. Because the most important thing is going to be this style of, any style of trading has to be a really, really good psychological fit for you. Because the war every day is not with the market, it's not with other traders. The war is between your ears. Right? Everything that's going to negatively affect you over the course of a trading day is going on right in here. And if you can get beyond that, if you can get to the point that you say, okay, well, what he's doing resonates with me, and oh, you know, I've talked to these other people and they're telling me, you know, this is how it affected them, and this is how they've managed to change their trading, and how they've become profitable, and how they've you know, launched on a second career, which is a really sort of a fun concept. Then I think you'll wind up being very happy with what you hear. So shoot us an email, and then make sure that you're in the room every day, and you'll get plenty of attention from our alumni. All right, let me take one more look here and see if we have anybody else who, oh, here's another one. Okay, that's a good question. So am I pre-programming the XRVs and then launching them manually? So that's a very good question. What happens with XRV is that I'm going through, and if the market is going to gap, right? So this is going to sound a little bit random, but you just sort of have to wrap your head around the fact that, you know, a lot of this is just from experience doing it. If the market's going to gap in the morning, and that gap represents a move of, let's say, 150 or 160 points, then I'm talking about the Dow. In that case, what I do is I defer my orders. So what you can do in your trading software, you're going to have to dig into whatever software. I know Realtek, right? So if you're a Realtek trader and you've got questions, you know, a lot of times if you call Realtek, they're going to tell you to call me. I've been using this thing for 22 years now, and I know how to work through this very quickly. Realtek, all you're going to do is right-click on the order in your Minder window, and you're going to say defer it. That's on a big gap. So 160 points seems to be the sweet spot for where I start cutting them off. You know, if it's a 50-point gap or a 100-point gap, then I try to look at which direction the market is gapping. So if I've got a long XRV for the morning that I'm planning to work with, or let's say I've got 2 or 3 XRVs that are on the long side of the market, and then the market's going to gap way higher, then what I try to do is defer those orders based on the pre-market price action in those stocks. Because what I don't want to have happen is market gaps up, the XRV gaps up, and then the XRV starts moving, you know, pops quickly lower into the acceptable range for an entry, and then keeps going lower, you know, as the whole market pulls back in again. So there's a little bit of that goes on. For the most part, the XRVs are just programmed as a set it and forget it thing for the morning. So before the market opens, I enter my my conditional orders. I say, let's say it's a long trade. I know what my allowable slippage is. So then I enter a conditional order. The condition's going to say, if the last price is less than or equal to whatever the maximum slip was that I was looking for, then buy stop limit at my stated entry price, right? That's the stop, and then the limit is the maximum allowable slip. So on the opens, you know, usually I want to get put into those. If they're available, I want to get popped into the trade. And the slip is usually, you know, the maximum slip that I'm going to take on an entry is going to be 10 cents, sometimes 15 cents, sometimes 20 cents, depending on the price of the stock. But for your average price stock, let's say about $10, I'm sorry, not $10, about $20, $25 up to about $50 a share, you know, you're going to look for a maximum slip of about 10 cents. And then on the higher end stocks, your maximum from yesterday's high to where you're willing to get filled today would be 20 cents. So those are just sort of rules of thumb. If you're on XRV, or if you're, it sounds like you're currently on it, or you're one of my guys. If you're on it and you just started and you're trying to figure that out, then what I want you to do is call me. So you guys can always call me if you're working with any of the stuff that we're doing. My number's 310-804-2248. That's my cell phone number. So just do me a favor, shoot me a text first and tell me, you know, hey, I wanted to talk to you about XRV, you know, whatever. Hey, my name is so-and-so. I want to talk to you about XRV. You know, can you call me back? And then just give me a callback number. And then usually I'll text you back in a few minutes and just tell you when I can be available to talk to you. That's not a problem at all. So most of these questions, you know, get answered very quickly, and you know, it's just a matter of me sort of figuring out where your head's at to figure out what it is that you need some help with. All right, I see there's a couple more questions in here. Take another look. Yeah, there's a recording. So the recording is going to be sent out to you as soon as this thing is done. So you should get a recording in about an hour. You should get a link to the recording. Historical statistics for the various strategies taught at Trader Insight. Where can you find them? So you should already have access, I believe, to the site, or that might go out tomorrow, I think, in an email. And when you go to traderinsight.com and you log in, then if you go to the Around the Horn trading plan, which is one of the things that you're going to get on the trial, if you go on the right side of the page, down about a quarter way down the page, you will see the archives of every single trading plan that was published since 2006. And then if you go to the results tabs, you can get the spreadsheets, and the spreadsheets have, you know, every day of every month. The months are all tabbed and everything's very well organized and you know, presented in a way that you can see it. So you've got spreadsheets all the way back to 2006 that you can look at. You can see how these things played out. All right. All right, well, this was a good group, and you know, I thank you for taking the time to come and check this out and listen to us. I've known a lot of you a long time. You know, I know a lot of you go back a lot of years, and you know, you just haven't tried some of this stuff yet, or you've been, you know, watching videos and stuff on the site over the years, or I know you from Traders Expos. But now's the time. Come on in and you know, give it a shot. Kick the tires. Again, if you want to sign up for something, traderinsight.com/seminar. That has the link to the two things that we talked about today. And like I said, if you do the XRV thing and you don't like it, no problem. We just, you know, we'll refund your money. So it's a 30-day money-back guarantee on that. And you know, if you're interested in trading the gaps, then you know, come on in and take that course, and I guarantee you by the time you're done with it, you're going to be an expert on how to identify these things. So a great time with you folks, and again, thanks for taking the time to be here, and you know, look for emails for future seminars, and if not, I will see some of you I know in New York, and some of you in Chicago, and some in Seattle at the upcoming shows. So make sure you come and grab hold of me and let me know that you were there. And also, if you guys have a minute and you can just send me an email and tell me what you thought of this format, you know, what you think of the online seminars, and you know, what it is that you think that I could do to make them better, I would appreciate that as well. All right, have a great one, you guys. Good trading tomorrow.